You can kind of think about it as how much money would I have to invest right now in order to generate $1 million a year each of the next however many years. Rule of thumb, and this isn't a great rule of thumb, but it's an okay one, is around a 25% return if you're taking on the risk of owning a business. Anybody will buy a business if it makes sense to them mathematically. Right? As long as you are a good business generating cash flow, you will have buyers out there. The trick is to identify the buyer that you are most valuable to.
Hello, friends. I'm Adam Loveridge. Welcome to the Home Services Marketing Podcast, Growth to Acquisition. I'm the owner and founder of Job Calls. We're a home services marketing agency specializing in heating, air conditioning, plumbing, and remodeling contractors. For more information about Job Calls, visit us online at www.jobcalls.com. Hello and welcome to the Home Services Marketing Growth to Acquisition podcast. My name is Adam Loveridge with Job Calls, and I'm really excited today because I'm being joined by Remington Curtis from Sunbelt Business Brokers. And Remington, thanks so much for being on with me here today.
Adam, it's my pleasure. It's nice to see you again.
Yeah, likewise. So, Remington, we had an opportunity to grab lunch here the last week, and what was really astonishing to me was how much knowledge and experience you have in business brokering, and particularly in helping home service contractors really net, I think, the highest multiplier for their business. And so that's really what I'd like to talk with you about, today at least. And I guess starting off, explain to me, if you would, what is a business broker? How do you guys operate, and how do you help home service contractors just in general?
Yeah, terrific. So business broker is just a merger and acquisition advisor. What we do is we specialize in helping businesses go through the process of being acquired by whoever their targeted purchaser would be, whether that's an individual, if it's another corporation that's making a strategic acquisition, if it's another investor or investor group that is out there. And so what we do is that's what we specialize in. And we work with everything along the ways throughout the entire process, including talking through the valuation, helping to make sure that sellers have a reasonable expectation of what's actually going to be available on the market, helping them understand what the timeline would be, what the upfront costs may be associated with that, the initial data lift that's going to be required, and just making sure that not just getting to the market, but also once you're on the market, how to avoid any landmines as you're going through due diligence and the contracting to make sure that you end up with the best deal possible that is not just maximizing your earnings at sell, but also making sure that you're protected going forward.
I really appreciate that. And I'm going to take a piece of what you already talked about in this, and that's the landmines. And I realize maybe we're starting a little bit from the backward end of it, but I think that it's the problems that happen are oftentimes the hot points that we want to talk about the most. So what are the biggest landmines that you see typically with, so let's say, an HVAC or a plumbing or a remodeling company that would like to sell? What are the big issues that they commonly run into?
Well, there's a lot of landmines that we can run into. Some of them are things that, sticking with the analogies, I'm able to go in and help them diffuse those problems. And a lot of those that I'm referring to are more along of the data and record side. So my background is as a CPA. I have a PhD in accounting. I was a professor for over a decade. And so one of the first things that we do once we sign a client is go in and help clean up your data record, because nothing will slow down a deal or destroy a deal like incomplete records, or it turns out that the financials that are being provided were not 100% accurate. Okay,
so just good accounting, good bookkeeping then is an absolute must, it sounds like.
Well, I don't know that it's an absolute must, but what is required is that you're able to have accurate reporting, even if it's not 100% clear, ready to pass an audit. You can still bring someone in like myself that is able to clean it up to the point that buyers are able to be comfortable with it. Does that make sense? It doesn't need to start off clean. It just needs to end up clean.
I think that does make sense. And when it comes to, financial reporting and things along those lines. What are some of the key metrics or ratios, P&L type things that a business owner ought to be paying particular attention to, especially if they're thinking about selling their company?
Well, let's just take a little step back and talk about valuation. Okay,
Perfect.
There's a very simple formula for valuation. Your business is worth the present value of the expected future cash flows. Okay, and so there are a couple important aspects within that. The first one is, and what you're asking about, are the cash flows associated with your company. If you're a larger company, then we're generally going to measure that using EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And so it's essentially a measure of the cash flow of the business. If you're a smaller business, maybe making below $1 million a year, then instead of using EBITDA, we'll use something called SDE, which is seller's discretionary earnings. And the concept is still the same. We're trying to measure how much cash flow is coming into the owner's pockets as a result of running the business. So cash flow is going to be number one, most important thing by far within your financial statements.
So cash is king.
Cash is always king. Cash is king for operations. Cash is king for valuations. You'd much rather own a business that is generating $1 million in revenue, but $500,000 in cash flow that's going to the owner, than one that's generating $5 million in revenue, but only $200,000 ends up in the owner's pocket.
Gotcha. Well, and you're bringing up, I think, a real interesting point in all of this, and maybe this is something you can elaborate on, but when it comes to HVAC or plumbing, what is a good percentage of sales, either seller's discretionary earnings or, EBITDA, that I won't try to spit back out because that's so many complicated words for me, but, what is a good ratio that people ought to be looking at? 10%, 15%? I mean, what's typical out there?
What we'd like to be able to see is maybe around a 12% EBITDA ratio is pretty healthy at that point. And if you're able to get higher than that, then it's better. But it depends so much on the operations, and it depends so much on the type of business. If you are a business that is very labor intensive, let's say that you're doing a lot of remodeling work, and so the materials are not as much of a cost, well, then your margins will naturally be better, because you're not having to spend as much upfront.
Gotcha. Okay. And when it comes to business valuations, themselves, I know we've talked about really, really high end millions of dollars versus, somebody making $1 million a year and maybe eking out, $120,000, $150,000 out of that. And I know that this is kind of a multi-part question, and so feel free to just elaborate on this, but what do you typically see out there in terms of valuations, either from seller's discretionary earnings or, earnings before interest, taxes, and depreciation, amortization?
So let's start off with an EBITDA. And
Okay.
This is a really complex question. I'm going to hate this recording because I know that no matter what I tell you, it's not actually going to be 100% accurate. All right. So anybody watching this, I encourage you to talk with a valuation specialist for your scenario. But rule of thumb, right now within the home services area, we're typically seeing a multiple of 4 to 5 times EBITDA for valuation. Now, that's quite a big spread, right? That's a 25% difference. And so I'm already giving you a decent amount of wiggle room on valuation. SDE, it's probably closer to the 2.5 to 3 times SDE multiple range.
Okay.
But again, SDE is going to apply for those lower level or smaller businesses as opposed to larger ones where EBITDA really is more appropriate.
So it is the lesser percentage of seller's discretionary earnings then relative to the amount of risk that a buyer would be looking at for, say, a $2 million business versus a $20 million business?
Well, it's just, you are right. Okay, so it is partly driven by risk. So remember, our valuation is present value of expected future cash flow. An important aspect in that is the interest rate that's applied. And so the higher risk to the buyer of acquiring this business, the higher the interest rate that's going to be demanded, and so the lower the valuation will happen. And so you are correct there. But with smaller businesses, it tends to be that there's a lot more relationships or institutional knowledge tied up with the seller. And so the seller exiting is a much higher risk event for those smaller businesses. And that's why we tend to see a little bit lower valuation for them.
I like that a lot. And two questions kind of come out of that. The first one for me then is, what is a typical interest rate that when you consider the present value of those future cash flows? And I realize we're talking about finance here, right? And this is stuff that I learned how to calculate in college, but maybe explain what present value is first of all, and then secondarily, what is a typical interest rate that somebody would look for if they're going to buy a business?
This is getting quite complex, but I'm happy to put back on my professor cap for you here. And so
you are a professor, so we might as well.
Take advantage. All right.
Absolutely.
So the present value, the concept there is that you'd rather have $1 today than $1 in the future, right? $1 today is worth more. It allows you to take that money and invest it so that by the time the future payment came out, you'd have more than just $1. And so present value is essentially doing the opposite concept of that. We're saying, if a business that we're looking to buy is going to make me $1 million in this coming year, and $1 million the year after, and $1 million the year after, how much would I be willing to pay in order to receive that $1 million a year annuity? Okay. In other words, you can kind of think about it as how much money would I have to invest right now in order to generate $1 million a year each of the next however many years. Okay. And so that's the concept of present value. Now, the interest rate associated with that, we are going to see an extremely wide range. Okay. Rule of thumb, and this isn't a great rule of thumb, but it's an okay one, is around a 25% return if you're taking on the risk of owning a business. Okay. You can go down quite a bit, maybe down into the 9-10% range. We've seen deals with valuations that close that would have a interest rate of about that amount. But more often we're seeing them in that low to mid 20 range.
Okay. And that makes a lot of sense for me. And then it kind of dovetails directly into the other question that I had, which was from an operational perspective. And we've talked about the difference between EBITDA and SDE and risk and things along those lines. And what you had said, if I'm kind of just parroting back, is that the more involved the owner is, the more risk there is in that transaction because they have that intellectual property in essence, that's built in. And so if I'm looking at buying an HVAC or a plumbing company, what would the ideal situation look like there when it comes to operational management? I mean, do you want to see the owner, essentially just drinking, coffee on the sidelines and collecting a check every month? Do you still want them involved? I mean, where would somebody really need to be in terms of being in a position to sell and have that be a lower risk transaction for a potential buyer?
The less involved a manager is, or an owner is, the lower the risk there is of them stepping away. That doesn't necessarily mean it's the right business decision for them to be completely absentee. What I'm saying is if all else being equal, the company would be worth more if the owner was absentee. Okay. However, as you know, lots of times when you're running your business, that's not a viable option. It just doesn't make sense to have a business and turn it over completely to somebody else. And so maybe the right way to think about it is to view your involvement within different tiers. The most involved you can be within a business and the highest risk to replace you would be if you are an owner-operator. You are the one providing the goods or service. Maybe it's operating under your license, right? And so if you step away, it's not just the management aspect that's happening and the relationships that are being taken away. It's the actual technical skills and ability that are being removed from the scenario. Okay, so that is the most involved that you could be. The next level above that is maybe you are not providing any operational support, but you are providing management and overseeing the company and helping with schedules or helping with the sales. And so that is another tier where clearly you're providing value and there's cost of you stepping away, but it's a little easier to replace those roles than it is your plumber, for example.
Sure.
And then you can move up even higher where you're not sales, you're just very high level direction kind of executive concept. You're focusing mostly on strategy. And then the final tier is when you are essentially completely absentee.
It's a kind of an interesting concept, and what I'm thinking about a lot right now is the E-Myth, right? And this idea of kind of slowly working, on the business so that you can essentially get yourself out of the business because you have processes and then people running those processes to make everything work. And so that it makes a lot of sense to me. And I think if I could just dumb it down and make that a little bit more palatable, is that number one, if you're still in a truck and you're the business owner, you got a problem. Your business is probably not going to sell very well or for a very high price because you are the business, And I've seen that happen. Actually, I had a client just at the beginning of last year that after a decade or so in the business really wanted to sell. And the challenge was he had done, $400,000 of income in the previous year, and obviously had a great margin because it was literally just him and then one other sub that was handling his installs. And, guess what? He was unable to sell his business. And because it's like you are the business and there's nothing you can step away from.
It's the vacation test. If you go on vacation and revenues and new jobs stop, you're probably too involved.
I love that. That is a really, really great analogy. Circling back really quick to, we were talking about multipliers and present value and what people see. And the other question that kind of came to mind for me was, do you see quite a few, what does a typical buyer look like? And more particularly, the thing that I'm really getting at is, do you see other HVAC plumbing companies that are going out and buying up other competitors in their area as a growth strategy? And is that multiplier the same in terms of that present value that they're looking for, or do they get a lot more by just, growing as well? So what do you see there?
We do see it across the board. It really is going to depend on the size of the business as to who your best potential buyer would be. So that's one of the nice things about working with an advisor such as myself, is we're able to identify for your business who is the buyer that formula is going to work out the best for, right? That either there's something about your business that's going to allow them to add additional cash flow beyond just what you're doing, but there are synergies in the acquisition. And so they're going to project in your acquisition more than just what you're bringing to the table. Or alternatively, maybe it's an existing company that's already working within your space. And as a result of that, they're going to be able to reduce the risk to them because they already have teams, they have sales process. They're really acquiring you just to kind of have growth and be able to expand their offerings, and some maybe within the same line they're currently offering, but just more of it. Mm-hmm. And so overall, anybody will buy a business if it makes sense to them mathematically, right? As long as you are a good business generating cash flow, you will have buyers out there. The trick is to identify the buyer that you are most valuable to. And so we do see this right now, that there are a lot of institutional money that's going out there, rolling up a lot of these HVAC type of companies in order to kind of hopefully one day take them public, or just with mass and being able to have brand recognition and processes. As you have more of these services under your umbrella, you're reducing your costs, right? You're getting economies of scale. And so we do see HVAC right now, that being a really hot market for institutional money.
It has definitely been the trend for sure. And I know as a marketing company, and frankly, one of the reasons why I started this podcast in the first place and focused it in on, the acquisition side of things, is because I've had several clients that we've taken all the way to acquisition. One of them was purchased by ARS Rescue Rooter and is now a pretty substantial portion of the Yes brand here in Utah. Another one was a company out of Oklahoma. And in all those situations, it hasn't ended up well for us because what ends up happening, I think, at a lot of times is that these private equity firms come in and feel like, hey, we know this better. We've got our entrenched vendors or whatever else, and so they come in and start chopping things apart. And it's interesting because I've seen a few different approaches, and I'm wondering what you've seen here too. In as far as, do we keep the existing brand and leverage that existing brand, or do we roll it up into our brand? And so in one of those acquisitions, the one out of Tulsa, they kept the existing brand of the business. The one here in Salt Lake City, they rolled them up into that Yes brand, like I was saying. And I'm curious what you see out there and what some of the advantages might be in terms of keeping the existing brand or rolling up into a larger conglomerate.
So are you talking about advantages for the buyer or advantages to the seller?
I'm talking really about probably advantages to the seller.
Okay, well, there are going to be a couple different advantages for when you're considering whether to have your brand assumed and go under the flag of an existing entity. And that would be a lot of times these deals that happen when they start getting into a little bit larger size, they're going to have a cash component at closing. And then there's going to be deal structures with earnouts. And the amount of your final payment is going to be dependent on reaching certain thresholds or goals that have been established in the deal. And so if it turns out that you are maybe a little bit of an unknown brand and you're being acquired by someone who has great branding, great name recognition, then that acquisition might be helpful to you to be able to reach the set goals. If it's the opposite, though, let's say that this is a large company that's trying to migrate and they're trying to get a new spot I'm in Utah. So let's say that they're wanting to come into Utah and have a new marketplace there. And they're telling you they're coming in and replacing your brand with one that's never been heard of before. People don't have a relationship or experience with it, but your brand they do. I would be a little bit wary about that, right? Because you may be losing some of that goodwill associated with your company that is driving your sales right now. And there's a possibility that your sales could go down as a result of that, which would hurt your overall purchase price.
That actually makes a lot of sense. And I appreciate how you started talking about the seller, but ultimately wrapped in the buyer's perspective in there as well. And so we've obviously talked about a few different acquisitions here that I've seen personally, one where that brand was kept, one where the brand was not kept. And kind of stepping sideways from that here just a little bit, what I'm curious to know is what are some of the common deal structures that you see out there, and what does that look like? Help me navigate that for our listeners.
Yeah, terrific. Well, everybody's preferred deal structure would just be cash at closing, walk out the door, and you are free and set.
Cash is king.
Cash is king.
All cash, I'm out. Thank you.
All cash, I'm out. That's right. However, what we find is that is rarely the case in most of these deals. The way that most deals will be structured is that there is a substantial cash portion at closing, and then oftentimes there is seller financing that's being included. And so the buying entity may continue to make certain payments with interest over usually a relatively short period of time, 12 months, no more than 3 years typically is what we work with. And then the third component of this is most of the time, the sellers are going to be requested or required to stay around for a transitional period. That is something that can be worked out within negotiations of how involved they are and how long it's required. But as part of that, there generally will be compensation as well to make sure that they're receiving a fair market salary. Okay. Then the fourth.
Well, and really quick on that, I mean, if you're running a business, you need to be paying yourself anyway. So I don't see that really changing that much, And if you're just living off the profits of your company without taking an owner's salary, I think you're probably not in a place to sell right now anyway.
Well, a lot of owners, what they do is they just live off of distributions that they make themselves. They don't need to have a set salary because those salaries are going to be subject to FICA taxes on both sides. And so they prefer just to take the one side payment of a distribution, and it saves them 7.5%. So there are reasons or tax advantages to it sometimes, and it is fairly common. But you're right. If you cannot live off of, afford to pay yourself a salary, that might not be the right time to sell.
Okay, fair enough.
And then staying on deal structure, I was talking about the fourth type of payout, and that is generally going to be an earnout of some sort that during the deal structure, you will be setting expectations or projections of what the company will do going forward. And then the final payout will be based off of how well you achieved or exceeded those expectations.
Now, in those scenarios where there is those expectations that are being put in place in terms of that future or that final payment, if you will, and assuming that the owner is still involved, what do you typically see there? Is the owner still able to essentially turn the screws even though they no longer own the company to make sure that they hit those numbers, or are they more expected to just be on that trajectory anyway and it just happens?
Generally, we're selling off of the expected trajectory already. And so that's kind of part of the negotiation process is we're telling buyers this is what the expectations are. And so the deal gets built around, okay, we're buying it at this price off of your projections. That's especially important if it's a growing company. For example, if you're a company that has $2.5 million in EBITDA, but you've been growing tremendously and you think that the next 3 years you're going to average across all three $5 million of EBITDA. Well, you don't want to sell at a multiple of 2.5 now. You want to be able to get credit for the fact that you already have contracts in place and the growth has been set up. You've invested in your infrastructure to support those higher numbers. And so sellers wanting to sell at what they view the future cash flows are, which are not the past, but these projections. Buyer is going to come in and say, hey, you're the expert. If you say it's going to be 5 million, we'll pay you as if it's 5 million, but it better hit 5 million. Right? If it doesn't, then we need to be made whole, right? And so in a lot of these scenarios, you have so much flexibility in a deal, not with individual buyers necessarily, but when you go out to the market, if one buyer is not willing to make the deal structure you're comfortable with, move on to the next, right? Find the next potential buyer. And so what we generally see is that sellers are involved in some capacity for at least a year. Usually it's about 6 months to 12 months of full-time activity and helping with the transition, but sometimes it's less. After that full-time transition, it's common they'll remain on as a consultant or as a member of the board until the full cycle of the transaction is complete.
I appreciate all of that. And one thing that's a question that's kind of coming up for me, along those lines is, what is the right time to sell?
I always tell people it doesn't sound right necessarily, but you'd rather sell early than late. And that's because as we're talking through this, you're getting a sense that this is a long-term investment or a long-term process. It's not just, I'm selling today, now I'm out.
Sure.
So you're not trying to sell necessarily at just when your company peaks. You're trying to sell at a time when it's going up. You're going to get credit for that projections up until the peak. You're going to have the earnout, and then preferably you finish with your earnout right at that peak, right? And then it plateaus or it goes down and you don't mind at that point. But what you don't want to do is peak, then sell, and then your earnings or performance are going to go down because it'll be a problem for you.
They'll essentially end up clawing back on the transaction at that point, right?
They can claw back on the transaction, or you won't be able to get a transaction complete necessarily because it can take many months in order to actually reach the end of due diligence and the point that you're ready to close. And if it turns out that performance is going down during those months, it's not unreasonable for the buyer to either renegotiate or walk away at that stage.
Gotcha. So if I'm a HVAC plumbing company owner and and we've been having some pretty good, growth and whatever else, like double digit, maybe even triple digit growth. And I'm starting to maybe worry about whether or not that growth rate is maintainable. That would probably be a good time to start thinking about maybe selling that, is what I'm hearing you say.
I think so, right? If you are thinking about selling within the next 5 years, if your horizon is 5 years, it's a good idea to meet with a professional, see what the market's like, and make a plan for when you think would be the right time for you to exit, right? Just back planning. Say, hey, I want to be done by 5 years, and I want to be 100% done in 5 years. Okay, well, let's go ahead and say there are 3 years that I'm willing after a sell to stay involved and help shepherd and make sure that I am maximizing the sales price and earnings on this business. All right, well, that puts me 2 years away. It's not unusual to take a year to be able to go on the market and complete the transaction. So now really I have essentially 1 year to be able to prepare to get on the market, right? And it doesn't have to be that way, right? Plenty of times we have deals that they go on the market, they're under contract within a couple months, and everything is closed within 12 months to 24 months. That happens. But the more flexible you are when it comes time to sell, the better position you are in to maximize your sales price.
Gotcha. And, to kind of plug you guys, obviously, a little bit here in this situation, what do you typically do for companies who are thinking about, well, I've got a 5-year exit. I know I want to sell. I know that I'm building this thing to sell. How do you consult with these guys, and what types of things do you, first, let me step back here just for a moment. First of all, is that a service that you offer to help somebody kind of strategically look at where they are now, where they want to be, and get advice in doing that? And then secondarily, how do you help them to meet those goals, expectations, numbers, to be able to successfully exit at a value that they want to achieve?
Yeah, terrific questions. So we do provide those services. The first thing that we do when we meet with a company is we learn more about them. We work with them under confidentiality to review their financials and understand what their past has been, as well as their projections into the future. And then I will work to be able to tell them what their valuation range would be as of today. If they decide to go on the market right now, I let them know what the valuation they should expect would be. All of that is free of charge. If it turns out that they are good with that valuation and they're ready to exit, then we start the rest of the process in order to actually get them ready to go on the market and go through the sales process. If it turns out that the value I tell them is, or they're not quite ready to sell, or maybe it's a value lower than what they're looking for, we have a conversation with them to say, okay, what is the number that you're trying to get? What's your goal? And we help them map out what they would need to do in order to achieve those amounts. And so we find it to be it's designed to be very educational and helpful, and just make sure that their expectations are aligned for when they go on the market, and they don't want to be surprised, right? This is a significant undertaking for anybody in their life. We want to make sure they are armed with as much information as possible going into the process.
Okay, excellent. And if I'm thinking about selling, and let's say that we come and we talk to you, or we talk with another business broker, and hey, your P&Ls look solid, your cash flow statements look solid, this is something that we really, think would be very viable on the marketplace. What is a typical time frame to go out and market your business for sale, get a buyer, go through that, and what does that process look like?
Yeah, it's going to change a little bit broker by broker. Okay, and so I'll tell you what we do in our office as our services as merger and acquisition advisors. The first thing that we do is we go through and perform a mini due diligence for the company. My background is as an auditor and CPA, and so I do a minor audit. I look at the company as if I was going to buy it. The reason we're doing that is trying to find any skeletons in the closet or potential red flags for buyers. And we're doing this because not that it's going to tank a deal. We're not trying to do that. We're just trying to identify what are the items we need to be prepared to provide responses on before going to the market, because every company has things that are not perfect or, a little bit of flaws, and it's fine as long as you're transparent about it. The market will work with you, right? What is a problem is if it's suddenly discovered and it feels like it's been hidden from the buyers. At that point, you're losing all trust, and there's no way that a deal is going to be able to go to closing. So we go through, we do a due diligence with them, identifying who the strategic buyers would be, who would be the best fit for them. We prepare marketing materials, we come up with our full plan, and then all that usually takes generally about a month in order to be ready to go to the market. And then at that stage, we start reaching out directly to who we've identified as the best buyer profile, whether that be individual and small companies cases, or what we're seeing more often is reaching out to not private equity firms directly, but the portfolio companies or the holding companies of those private equity firms who have the mandate to grow. And so they're growing through acquisition of similar types of businesses.
So if I'm hearing you right, there's private equity backing private equity.
Not entirely, but yes, in some sense. I mean, what generally happens is that these private equities, let's say they want to get into HVAC or the MEP space, they'd come in and they'd buy some brands, and these now becomes the brands that they're working under. And they don't want to buy a competing HVAC company. Rather, what they'd like is that brand that they purchased, maybe to go out and buy your business, right? So you're not necessarily directly under the private equity. You're under the holding company of the private equity company.
Gotcha. That makes a lot of sense too. And you mentioned in the beginning of this, and I'd like to circle back to it, this idea of IPO. And I think that for most people, listening to this, the thought of doing an IPO is probably so far, out that it's not even feasible. And is it a valid approach if let's say you are a, $40 million, $50 million HVAC company? Is it possible to simply take your company public or otherwise, draw in capital to go out and acquire yourself and do what these private equity firms are doing? Is the IPO simply a mechanism of the big boys when they are looking for absolute liquidity, or does it fall somewhere in between?
So your question is IPO an option? Yes. Is it the right option? Probably not. Okay. The costs associated with that, the regulation, the expertise that you're having to bring in, it's just a completely different business. Now, if it turns out there are plenty of owners that have the ability or are capable of doing it, if that's what they focused on trying to do. But it's such a different world that you're swimming in. My partner, Dean Wiltsey, he has taken a company public on the NASDAQ. He's been through the IPO process. So that's something, if you are considering, be happy to sit down and talk it through with you. But for the most part, it's probably not the best investment of strategy, unless your goal is to take your company and acquire a lot and get into the hundreds of millions of dollars stage. To do that, you're probably having to become a portfolio company of a private equity firm, or at least work with one in order to have the financing to go out and make acquisitions to grow to that size. And so instead of you now becoming, looking for a buyer, you become the buyer of all these other businesses on the market.
And that makes a lot of sense. I was just more kind of curious about that, frankly, because, you hear about people going IPO all the time. Is that a viable strategy in HVAC and plumbing? And it sounds to me like what you're saying is that, yes, it could work, but really your intention needs to be like, we want to make $1 billion a year in sales, essentially.
Yeah. And the thing that happens is when you hit an IPO, now suddenly you have all this money. Mm-hmm. And you are expected to spend it, right? Not sit on it. Your mandate is to grow. And the way that you do that is through acquisition, because you can't grow organically nearly as fast as you can through acquisition. And so if you are doing this IPO approach, it's because you have intentions to really go out there and continue to acquire other businesses.
Awesome. Thanks for sharing the information on IPOs. It was just kind of something I wanted just to hit on really quick. But this has all been really, really great information. And for somebody who HVAC plumbing, company, remodeling company, any home service business that is thinking about acquisition, that is thinking about selling at some point in the future, but probably not there yet. I mean, obviously, if there's one thing I've taken out of this, there's a lot of information out there, and I'm sure we've probably just scratched the surface. What resources are out there for people to really learn more about what they should be focused on here if they do want to sell, and how can sellers get educated on the process of selling their business?
I think the best way to do it is to be able to contact a professional that you are comfortable in what their opinions will be. And so hopefully, people can reach out to me and my partner, and we'll be able to provide you our experience and our thoughts, answer your specific questions. Each business has a different set of circumstances that they need to deal with and that they're going to want to explore and consider. And the truth is, the only way to really dive down into it is to meet with somebody like me that's an authority in the area to be able to give you the answers you want. So one area that we haven't touched on at all is ESOPs, right? Employee stock option purchases. And this is a way that many owners, they are very grateful to the workers that have been there with them every step of the way, helping them to build the business. And they'd like the idea of being able to turn over the ownership of the company to those next generation of workers, or those that have helped build them up. And so ESOPs is a way that you are able to essentially cash out or sell at a good valuation to your employees. And the employees don't have to be sitting there with a bag of money. Instead, we have structures in order to assist them with getting that funding. So ESOPs are extremely complex, but that would be another thing that you could sit down with someone and discuss.
I like that a lot, and it brings me actually kind of thinking about another client that I have, and a common thing that we see, frankly, where it's that generational transfer of the business from original owners to now that next generation, sons, daughters, that sort of thing. Would it be worth plumbing HVAC company owners' time then to talk to a business broker if their goal was to essentially hand the company down?
Yeah, I do think so. I mean, at the very least, they'd be able to provide guidance on deal structure and making connections on what the expectations would be, maybe the valuation, making sure that it's fair across the board to everybody.
Gotcha. Well, if somebody were looking to, reach out to you guys, how would they go about finding you and Sunbelt anyway?
Sure. So Sunbelt Business Brokers is the largest brokerage network within the world. And so if you just Google Sunbelt Business Brokers, I'm sure you'll find a lot of options. For myself and my partner, Dean, we are the partners at the Sunbelt Business Brokers of Utah. So if you just Google that, you'll find us, send us an email or give us a call, and we respond very quickly. Fantastic.
Well, Remington, this has been absolutely wonderful to have you on. I appreciate you, first of all, educating me and educating, our listeners as well. With all of that said, I think we'll go ahead and wrap up here today. And again, I just want to thank you for sharing your knowledge, sharing your expertise, and for coming on here today anyway.
Thanks for letting me join you, Adam.
It's absolutely been my pleasure. And again, friends, I'm Adam Loveridge with Job Calls. This is the Home Services Marketing Podcast, Growth to Acquisition. And I look forward to catching you on the next one.